Good morning and welcome back to Morning Markets from True Potential, Paul Durrans, Investment Director. If we start by looking at last week, we saw positive returns from most of the stock markets, leading stock markets. So the US market was up over 1%, which is good to see despite some of the volatility that we've been experiencing. That was led by the big growth companies in the US, so the likes of Meta and Google doing very well over the course of the week. Sectors such as energy, utilities and materials saw declines. In terms of the week ahead, what we'll be looking out for and what the market will be focusing on is earnings reporting. So companies in the US will be reporting their second quarter earnings, and this gets a lot of attention and it has becoming more into focus over recent weeks, given the trends that we're seeing in economic growth, which has been slightly to the downside. Also, the tightening of financial conditions. We've seen interest rates being increased in the US, and also inflation continues to dominate headlines. So this will all feed into the earnings picture, and that will kick off on Thursday from US banks. They'll be reporting. So far, commentary is talking about strong positive net interest income and also robust credit growth. In terms of last week, what we really focused on and what the market focused on was the data coming out of the US on Friday, which was jobs data. Really important because jobs, when they're very strong, when the market's very strong, which it has been for the last 12 months, that really means demand is high, and that then feeds into the inflation picture. What we've seen over recent months is the Federal Reserve have been raising interest rates to try and curtail demand in order to help bring inflation back down to that 2% target that they have. The data on Friday showed that the US jobs market remains very strong. 372,000 new jobs were added over the course of June, which is much higher than what was expected. The unemployment rate remained at 3.6%. We also had wage growth. Wage growth is important because it has an impact on inflationary prices in the future. When wages are high, people consume, and that pushes prices up more. So what we had on Friday was wages coming in month on month at 0.3%, which was in line with what I expected, and 5.1% year on year. So the response from the market, because it became higher than expected, means that they took it that the central bank, the Federal Reserve, will have to continue to raise interest rates, perhaps more aggressively, to bring down demand and therefore bring down inflation. Looking ahead for this week, inflation will dominate on Wednesday when we get the US inflation readings. So watch out for that. If it becomes in higher than expected, expect more volatility and some weakness, particularly in the bond market. If it comes in below, we'd expect positive returns. Elsewhere, we'll get Chinese data, exports and imports data, really important not only for Chinese economic growth, but global growth as well. And we also get retail sales and sentiment data from the US to watch out for. That's everything from us. Thank you for listening, and we'll see you tomorrow.
If you're interested in taking your investing to the next level, or would like to know more about the options available to you when you retire, then download our free guides to ISAs and pensions. These are available in the video description below.